Namaste and welcome to VD Decode YouTube channel.
Credit cards are sold as an expansion of your personal wealth, a promise of rewards and prestige. But beneath all the heavy metal and high-end branding, they truly function as precision-engineered traps for the impulsive. The industry operates on a zero-sum math. Every first-class flight and luxury hotel stay enjoyed by a savvy user is funded by the high-interest payments of someone revolving their debt. The stakes extend to your long-term financial mobility. When you apply for a mortgage or a business loan, banks look past your salary to focus on your CIBIL credit score. A lender will often approve a loan for someone earning 6 lakh rupees a year with a pristine 800-plus credit score, while rejecting a 30 lakh earner with a history of missed payments. Winning this game requires you to treat your credit limit with the same restraint as a debit card, spending only what is already in your bank account, while routing every major expense through the card. The system relies on your inattention. Whether a credit card serves your growth or drains your savings depends entirely on which side of the mathematical divide you choose to inhabit. Reaching an elite credit score is a mechanical process. This breakdown shows 2 factors carry the most weight. Payment history demands punctuality, and utilization requires keeping spending below your limit. Building strategies suggest starting early. Maintaining an account from your 20s establishes a long track record of reliability banks prioritize. A common misconception is that closing an old, unused account cleans up your profile. In reality, as noted here, shutting down an old card deletes a portion of your history and shortens your average account age, directly harming your score. For those with poor or no credit history, an FD-backed secured card is the primary tool for score repair. It allows you to prove payment discipline using a small fixed deposit as collateral. Banks prioritize this track record. High scores allow them to offer lower interest rates on major loans, effectively saving you lakhs in interest over time. However, applying for multiple cards simultaneously triggers hard inquiries that bureaus interpret as a sign of financial distress, causing a sharp drop in your score. Score building is a game of patience, keeping old accounts active with small, manageable purchases, even if you no longer use their specific rewards. Your monthly statement contains legal tripwires designed to trigger high-interest compounding debt. Navigating them requires seeing past the bank's framing. The minimum amount due trap is a prime example. Paying only 5% avoids a late fee, but leaves the remaining balance to compound at huge interest. Furthermore, withdrawing cash from an ATM triggers flat fees and immediate interest on your entire month's spending. There is a persistent idea that carrying a balance helps your score. This is false. It is an expensive mistake that benefits the lender while providing zero benefit to your credit profile. To protect your score, aim for the 30% utilization rule. Some users even pay their balances before the statement generates to report a lower usage rate to the bureaus. Punctuality is also vulnerable to the calendar. A payment made on a Friday that doesn't credit until Monday can trigger a late fee and a permanent hit to your score, unless the bank issues a clearance letter. Exceeding your limit doesn't always result in a declined card. Instead, issuers may allow the transaction and apply heavy over-limit charges for every day the balance remains too high. Effective defense removes the illusion of the minimum payment. View your balance as a liability that must be cleared in full every 30 days. Master the defense, then pivot to offense. The disciplined pay heavy annual fees to access travel subsidies that completely dwarf the initial entry price. This Annex Platinum travel case study illustrates the math. A 10,000 rupee fee can yield over 25,000 rupees in vouchers and hotel stays, provided you hit the specific spending targets. Optimizers use multiple cards to maximize returns, designating specific cards for categories like fuel or travel. However, this requires meticulous oversight. You must review statements line by line to catch micro-errors that compound over months of inattention. The modern toolkit also includes UPI credit cards, such as the Tata Neu RuPay. These allow you to earn rewards on daily microtransactions that were previously excluded from the point system. High-volume spenders route non-discretionary costs like rent or EMIs through their cards. This volume triggers the annual spending thresholds required to waive premium fees. Redemptions are also strategic. Transferring points at a 1-to-1 ratio into programs like Marriott Bonvoy can turn routine grocery shopping into stays at luxury properties. For specific profiles, secondary perks like zero-cost golf rounds and concierge services provide significant value that outweighs the card's annual cost. With airtight discipline, high-volume spenders transform non-discretionary expenses into luxury subsidies, using premium cards to tilt the entire industry's math in their own favor. Your strategy depends on your archetype. Rebuilders under $750 use FD-backed cards and autopay. Everyday users use all-rounder cards, keep utilization below 30%. Optimizers spending over 10 lakhs route large expenses through premium cards to maximize redemptions. The credit card industry thrives on the inattention of the many to subsidize the rewards of the few. If you cannot automate and track your spending, the card becomes a liability. Choose your strategy based on a realistic assessment of your own discipline rather than the promised perks.